We have our next panel discussion is going to be compliance issues for cannabis business owners, taxation, liability, and the ERTC. Moderator is Steve Gelsi from MarketWatch, and then we have Sandy Suchoff, founder and CEO of CannaCPAs, Jeff Booker, COO and founder of CannaCoverage, and lastly, Tom Saugaveau, founder of and CEO of ERTC Filing. Please welcome our panelists to the stage.
Hello, everybody. My name is Steve Gelsi. I'm a reporter with MarketWatch, and I'm really glad to have this panel, Compliance Issues for Cannabis Business Owners, Taxation, Liability in the ERTC Program. Why don't we have each panelist introduce themselves, starting with Tom Saugaveau on my right, and then Sandy, and then Jeff.
Thank you very much. Tom Saugaveau, founder, CEO, managing partner of ERTC Filing. We are an ERTC company, but we are based out of an accounting and tax firm that transitioned most of our services over to ERTC services. So been around for 15 plus years and really enjoy focusing primarily on smaller businesses, micro businesses, 50 employees and less, and ways to help those businesses.
And how'd you get involved in cannabis?
Well, cannabis really kind of introduced us, and I'll talk about this a little bit more later in regards to the tax rules that apply to cannabis industry and some of the benefits then in the ERTC that actually helps them because of those rules. So we'll go more into that.
Oh my gosh, we've not heard of many things helping anybody, so that's good. We'll have to hear more about that. Sandy, you're up.
Hi, I'm Sandy Suchoff, CPA. I'm the CEO and founder of the CannaCPAs. While we're based here in New York and New Jersey, we service cannabis businesses nationwide. We're in practice over 25 years, doing cannabis over 7 years. We have clients from Maine all the way to Alaska. We strategically help cannabis businesses increase their deductions to save money and help with advisory, CFO services, and exit planning. I myself have been on MSNBC, Fox, Chasing News, PBS, Channel 13, Marijuana Venture, the National Marijuana News, Snoop Dogg's Mary Jane, CPA Trend Lines, Cannabis and Tech, Cannabis Radio, Purple Haze Radio, co-authored a book, have a new book coming out on how to run a profitable cannabis business. And I speak nationwide, educating folks just like you, owners of CEOs of existing or prospective cannabis businesses on accounting and tax strategies, as well as how to run a profitable cannabis business and case law.
Okay, so thanks. Jeff, you're filling in for Nichelle Santos, the founder and the CEO, who is. But tell us about yourself.
Thank you, Steve. My name is Jeff Booker. I am the founder and chief operating officer of CannaCoverage. CannaCoverage is a cannabis business insurance and risk management consulting firm. I've been in the industry as far as insurance for almost 30 years at this point. Got pulled into the cannabis industry in the last couple of years because of the need for experienced risk management and brokerage services in an industry that is inherently risky, right? So you need to make sure that your business is buttoned up with risk management strategies. And we are based in Newark, New Jersey, just across the river, but doing business coast to coast, including here in the Empire State. So happy to be here, and we look forward to the conversation.
Jeff, I'm just going to throw you a quick question off the top of my head. What percentage of time do most of your clients spend on compliance issues? It's a big chunk of the time, right? Maybe 10% or more.
Well, some would say it could be a little more. I would say that a lot of folks don't necessarily pay as close attention to the details as they should, because in any business, but certainly in this business, if you are not appropriately risk assessed and mitigated and transferred, you will have more frequent and more severe claims. And in this world, a bad day can put you out of business. And what we do is try to make sure that that bad day does not end your dream for yourself, your family, and your investors, for that matter.
Okay, well, we're going to start with 280E. I ran a finance panel yesterday, and everybody there was wringing their hands about 280E. And there's really not much around that you can deal with it. But Sandy, give us a history of the 280E, what that is, and how people run up against that all the time in cannabis.
Yeah, before I even explain about what 280E is, I'd like to preface it by saying any business, whether it's legal or illegal, is supposed to file tax returns and pay taxes. And there was a catalyst tax case, Edmondson versus Commission, I believe that was in 1974. Edmondson was in the business of trafficking or selling amphetamines, cocaine, and marijuana. And like other drug, arrests, they take the market value of cash and drugs that they confiscate at the time of the arrest, and they assess taxes on that. And Edmondson was allowed to reconstruct his expenses. So he took things like scales and travel and his purchases, what it cost to buy, and rent and utilities and auto, and everything except a few receipts that he couldn't substantiate, I believe it was travel related, were allowed to be deducted. So this didn't sit rest, well by the federal government. They weren't happy that an illegal drug dealer could take these deductions. So that was the catalyst for a tax law, Internal Revenue Code 280E. And 280E says that you are precluded from taking any deductions or credits if you are trafficking controlled substances found on Schedule 1 or 2 of the Controlled Substance Act, and that it is illegal federally and/or in the state in which you are conducting business. Now, thereafter, the tax court has held on numerous occasions that cost of goods sold is not deemed to be a deduction for this purpose. Rather, it's seen as an adjustment at arriving at gross income. And if you ever look at an 1120 corporate return, you'll see total gross receipts less cost of goods sold equals total income. So it's predicated upon that. And the technicality is that cannabis businesses can't take ordinary deductions and credits, but they can take cost of goods sold. So we'll probably look at later those strategies or ways to increase those legitimate deductions.
Okay, anybody else here have any thoughts on 280E and how that's evolving? I guess some of the states are starting to boot it or to eliminate that. Anybody, any thoughts on that? Sandy, you're going to follow up on that?
Well, in the state of New York, effective 2022, at the state level, you can add back those expenses. In the state of New Jersey, they just passed legislation the year following the enactment that in 2024, you can take those federally disallowed deductions on your tax return. So that means for New York and New Jersey, and there's many other states, there's New Mexico, there's Oregon, there's Montana, a myriad of states that do allow you to take federally disallowed deductions.
Okay. Anybody else want to weigh in on 280E, or you guys are all there?
I will stay in my lane.
Okay, you're gonna stay in your lane. Okay, and so why don't we talk about some other good news out there? Is the employee the ERTC tax credit, the employee retention tax credit? That's what you're focusing on, and give us a rundown on that.
Correct, employee retention tax credit. So I'll talk a little bit about that in particular, but then bring that back to the 280E because there is a section there, as I mentioned earlier, that applies that's more of a benefit for the cannabis industry. So ERTC, what it is a COVID-based tax credit that rewards employers that had employees that are eligible for this program and basically reimburses them for a portion of their payroll that had employees during COVID, so 2020, 2021. I'm sure probably most of you, if you're in business, have either received a phone call or seen an email or anything like that. The ERTC industry is a little bit crazy right now just because of the amount of money that's coming to businesses, which I'd love to talk about that a little bit more later. But the benefit for this program for those that were in business and trying to follow the rules as far as reporting payroll on a 941, making sure to withhold taxes and report those taxes and pay those payroll taxes. And in many cases, when you filed your income tax, that 1120, you weren't able to take that write-off for the payroll. Well, one of the big things the IRS is saying right now is the ERTC is taxable to you as a business owner. So you get this money, $500,000. You need to go back to your original tax returns and reduce your payroll expense by that $500,000. The benefit for the cannabis industry is you never reported that as a payroll expense initially. So because you never reported it, assuming you didn't put it in cost of goods sold, as Sandy talked about, you don't have a deduction that you have to take and basically reduce that payroll expense, which in essence makes these funds to cannabis industry that didn't take that deduction tax-free. So there's a very big aspect there that helps out for those that are actually filing for ERTC. Again, could spend a long time going to making sure you're careful. As a business owner, you're the one that carries liability. Never trust a company or a provider, especially if it's not somebody you don't work with. But making sure that you, as the business owner, are being extra careful about what you do here. So that's just one of the benefits that helps out a little bit as it deals with the cannabis industry.
And can you give us a ballpark figure on how much that can help somebody or help a company?
There's a couple figures that go out. So we get people that ask us this all the time. You know, what would I be eligible for? A lot of companies that are providing these services like to quote the $26,000 per employee. That is on the high end of really what you should be eligible for. I like to quote it in regards to PPP. That doesn't really help this industry because a lot of people didn't get PPP. Usually 1 to 2 times what you got in PPP is a good way to look at it. So, and every business is different, so it's really hard to give you an exact number. Anybody who's willing to give you an exact number very quickly is probably not doing a good job.
Okay, so the IRS. So just to kind of recoup some of the things we've heard. The IRS will not allow you to take a lot of the deductions, but some of the states are allowing you to take the deductions now. And Jeff is talking about insurance. Jeff, what's the most popular insurance line you have? And also, insurance companies can insure cannabis companies even though they're not federally legal, right? So just go over that.
They can. We get this question a lot. How are you able to do this, et cetera, with the federal cloud that hangs over cannabis? And I explained to someone earlier, in the insurance space, you have what are called admitted and non-admitted carriers. Insurance is regulated at the state level, not the federal level, so that the states have their own laws, their own structures, et cetera. A lot of the coverage that is being offered for general liability, product liability, property, workers' comp, et cetera, crop insurance are being offered by non-admitted carriers, meaning that they are allowed to do business in that particular state, but they are required to let the public know, the consumer know, they're non-admitted, they're specialty carriers, right? So that provides the ability for someone to be able to get coverage for something that a very short while ago was illegal at the state level as well, and wasn't really available. So one of the things that we try to do is to help our clients understand the importance of risk management and insurance, because again, when you're dealing with a supply chain that may have some weak links in it, as you're standing up an industry, you want to make sure that your business and your entire supply chain, if you can, has the appropriate coverage to protect you against the inherent risks inside the industry.
So, yeah, you mentioned, Jeff, if a company doesn't have the right insurance, they could really threaten their business. Your company's been working in 22 states. Any horror stories, without maybe without naming names, any kind of lessons that you've learned from the industry? Yeah,
we certainly have seen the common smash and grabs out west, in the dispensaries. We've seen that. One of the areas, sad to say, that's pretty hot right now is employee theft. It's not very easy, but it's a little bit easier for an employee who really knows your system and really knows where things are, with the camera angles, all that stuff, right? Can begin to skim off the top. We see that, unfortunately. And again, these are inside jobs. Of course, when it comes to crops, you've got lighting failures for inside grows that have fried crops and that type of thing. So one of the other things that we're seeing is the importance of what's called directors and officers insurance coverage. That's really important. It protects the ownership and the management of your business from being personally liable for things that your company may get sued for. It's not cheap. I mean, it's just not. But more and more investors are demanding it because they want to be protected by what may come. So this is a serious business and requires a serious investment and a serious mindset to make sure that you're appropriately mitigating your risk.
Yeah, directors and officers insurance, that's a big deal in the corporate world, and it's interesting to see cannabis industry getting into that as well. Sandy, what is the best entity structure for a cannabis business and why?
Okay. Can I talk, if it's okay, about strategies first, only because that affects different verticals, if that's okay. So we just talked about 280E and that how it limits your ability to take ordinary unnecessary deductions relative to other businesses. But there are some tax strategies that we can implement, and they are based upon your vertical. So a grower, although one might think that's governed by an agricultural tax code, that agricultural tax code has preferential deductions and credits. So that, along with processing, falls under the manufacturing tax code. Dispensaries and deliveries will fall under retail. And I would say that the same strategies for those could govern distributors, wholesalers. With respect to growers and processors, the manufacturing tax code stipulates that if you issue GAAP financials, generally accepted accounting principles, that's a national standardized method of accounting governed by the Financial Accounting Standard Board, designed to promote consistency, comparability, communication, and so forth. But nevertheless, if you adhere to generally accepted accounting principles, there are additional deductions that your grow or processing can allocate to cost of goods sold, the only thing they have. And they include officer compensation, that is production related. So if you're growing or processing or indirectly supervising those activities, pro rata, your wages, payroll taxes, and payroll processing fees can be allocated to cost of goods sold. Employee benefits, which we know for any potential exit plan down the line, employee incentivization is key. But health insurance, retirement, profit sharing, and so forth on any grow laborers or processing laborers, any direct labor, production related, can be allocated to cost of goods sold. A big one is depreciation. So your build out construction, your HVAC, your lights, your processing equipment can all be depreciated. Only difference is we're not using an accelerated tax depreciation, we're using a GAAP method of depreciation. Insurance, so here we can write off what Jeff does. Not just your cannabis, but your production-related activities or facility. You can allocate that to cost of goods sold. Certain taxes, like real estate taxes and taxes attributed to inventory. Scrap, spoilage, even when you take a sample to be tested, we can account for that within cost of goods sold. And lastly, production-related administrative costs. So we write off part of our accounting when it's related to inventory or absorption accounting. You hire a consultant for your grow or your processing, like a formulation consultant or grow consultant, we can allocate that. Metric, BioTrack, any of these POS softwares, they're seed to sale. Half of it is geared towards inventory, half of it is for sale, so we'll write off half of that. And also the tags, when you have to tag along, for a track and trace system, I interpret that as being related to inventory and will allocate that. Now, our retail, in contrast, is more severely limited by 280E because, one, by virtue of what you do, there's a less inventoriable cost of goods sold costs. And more things are designed to facilitate a sale. We still do GAAP accounting for a retail, and the reason being is that to the extent that we have a clean set of books, thoroughly documented accounting, substantiating work papers, and this national standardized method of accounting, we're going to gain credibility in a statistically more likely federal tax audit. And why is it statistically more likely to get audited? One, it's federally illegal. Two, due to the scarcity of banks, transactionally, it's a heavily cash-based business that the IRS is cognizant of. But specifically, I employ, and I've developed and improved over the years that we've been doing accounting for and tax for cannabis businesses. But I have 3 specific strategies that we employ for retail. The first one, well, let's talk about the tax code for retail. Allows for acquisition costs and freight in, meaning the cost of getting your products, to be allocated to cost of goods sold. We interpret acquisition costs to also include those costs that we deem necessary to preserve, protect, and insulate those costs. So for instance, your security system, the monitoring system, is clearly protecting and insulating. So the monitoring system will allocate that to cost of goods sold. Any labor related to that will allocate to cost of goods sold. Even cameras or equipment that, let's say, they're under $1,000 and we're not capitalizing as fixed asset, we'll allocate that to cost of goods sold. Your inventory room in your store, your storage facility for your delivery, that is preserving, protecting, and insulating your cannabis, aka acquisition costs, because you're taking in your inventory, you're counting your inventory, and let's say packaging not for resale, but packaging to maybe ease the inventory counting process. So pro rata predicated upon your square footage of your inventory room in your store, or in your delivery, the amount of space minus any office space will allocate rent and utilities to cost of goods sold. So for instance, if you have a 2,500 square foot brick and mortar dispensary and 250 square feet is your inventory room, will allocate 10% of your rent and utilities to cost of goods sold. Labor, your bud tenders, not deductible. Your delivery guys, not deductible. But how about when they go into the inventory room to intake the inventory, to count the inventory, to package it, etc., then ideally have them punch in and punch out, and that labor pro rata, wages, payroll taxes, payroll processing fees, work comp will allocate to cost of goods sold. Similarly, acquisition labor, if you guys call up to reorder products, it could be cannabis or non-cannabis products for resale, that also will allocate pro rata to cost of goods sold. And lastly, for retail, inevitably you'll be selling non-cannabis costs, non-cannabis items, such as Farm Bill compliant CBD, merchandise like hats and shirts and glassware and vapes and paper and cones and etc.
House plant by Seth Rogen. You might be selling some of that too. That's
okay.
Yeah, just jumped in as another example. Go ahead.
And your POS software will actually track your non-cannabis sales. Predicated upon your non-cannabis sales, we will actually take some non-cost of goods sold expenses. So let's say, for example, you have $975,000 of cannabis sales, $25,000 of non-cannabis sales. 2.5% of your sales are derived from non-cannabis sales. So the residual rent, utilities, wages, payroll taxes, payroll processing fees that we didn't allocate to cost of goods sold, we'll take below the line. 2.5% of professional fees, office supplies, internet, computer supplies, janitorial, bank fees, and other similar administrative costs will also deduct. However, we will thoroughly document it in our accounting work papers, so the formulaic calculations, the backup sales reports. We will itemize it. We have a separate accounting in, let's say, a QuickBooks or other bookkeeping software. We itemize it on the tax return, and we have a disclosure statement with the appropriate legal verbiage to substantiate it, and we've never had a problem deducting that. So those are the essential strategies that we employ. A mouthful, but sorry about that.
Wow, that was a long one, but it was really interesting. There are a lot of different things deductions you can take. So, Tom, talk about some of the risks that you were mentioning earlier, and dive into that a little bit more, and then we'll go to Jeff.
Yeah, I'd love to. There was one thing that Sandy said that I want to go back to my previous comments. So when you do take some of that labor and do allocate that to cost of goods sold, just so nobody here is misunderstanding and goes back to their accountant and says, I get this money tax-free, that's not completely true. If you did take that labor as cost of goods sold, took it as a write-off, you are going to have to go back and adjust it. IRS always says you have to go back to the original return and adjust your payroll expense for what you're getting reimbursed for. So I'm glad she brought that part up, because that is part of how ERTC works. But in regards to some of the liability, and you know, as we look at insurance, we have to do a lot of risk management and mitigation. ERTC is exactly the same. We have to take into consideration there is no case law for the most part having to do with ERTC at this point in time. So every claim for ERTC is something that falls, as I said before, with the business owner to consider your liability of taking this on. So with this industry, it's such a large amount of money that there's been a lot of players that have come into this industry, advertise like crazy in order to try to get your business, to try to get you this money and tell you, hey, I can get you a large amount of money. If you trust me, I'll make sure to go through and do that. What this created is an industry that unfortunately is abused, and a lot of business owners are finding that they are not only getting overcharged by getting charged a percentage of what they're getting back, but they're getting overqualified for what they should actually be getting. And I spoke last night with a particular writer who challenged me to actually come up with a specific example. So I came back to my staff this morning and said, hey guys, what type of examples have you guys seen of this? And the example was a company that basically got about $500,000 back in ERTC from another provider, reached out to us because they were starting to have problems with the IRS. The IRS came and said, hey, you've overqualified yourself. You don't qualify. Every quarter that you go through this, you have to qualify yourself. And this business that provided these services for you qualified you for 7 quarters. Unfortunately, you really only qualify for 4. So instead of getting $500,000 back, you really only get $300,000 back. You need to pay us back $200,000. Well, by the time the company reached out and contacted us, that $200,000 that they had to pay back with penalty, they had already paid 30% of that to the provider to do those services, and the provider is helping them zero on it because they trusted that provider to do what they're doing. The IRS has recently, in fact, just last week, did another release on the risk that business owners need to be careful about when they do it. They specifically list things to look for. Contingency fee basis. If the person that's doing this for you is charging a percentage of what you're getting back, they say always don't work with them. If you pull that up, you'll see it right there, and that is probably a majority of ERTC providers. Other examples they give you is making sure to double check and make sure that they're asking the right questions. You know, this PPP program that came out when ERTC came, you can do both, but you need to make sure that you're not double dipping, using funds that you used for forgiveness of your PPP in what you claim for ERTC. That's a very important one to look for. Making sure that you're not including owner's wages. If you're not supposed to be including owner's wages is an important one to look for. And again, make sure you're not overqualifying yourself for more periods. If you talk to a provider for these services and that provider quickly says, yes, hey, we can get you qualified for X amount of dollars for a period of time, there's a lot of taxation and tax rules that go into understanding what this is. That's a red flag that chances are there's somebody that's not going to help you well, which is why the IRS is coming up and sending all these releases out. Us tax preparers, we know this because we see this, but maybe you as business owners aren't seeing what we're getting. And the American Institute of CPAs actually just did a release a couple of months ago to CPAs saying, hey, if you feel that your client who needs to come back and amend their income taxes, if you feel that they had someone that didn't file this correctly for them, do not file an income tax amendment for them. So you might find that your CPA actually won't help you by going through and doing that income tax amendment because of the poor job that the ERTC provider had done initially on this. So it's unfortunate to see that because this was meant to be a help for millions of businesses. Really love the good positive stories, and I've got some good ones I can definitely share on there. But I definitely want every business owner, if you can leave with one thing as far as the ERTC, to understand it's on you to make sure you do it correctly, to make sure you're doing your due diligence and looking at the work that's being done. Google IRS ERTC warnings. That'll give you the list of what the IRS tells you not to look for. Something to help.
Okay, we're gonna open up to questions in a minute. If anybody has a question, start thinking about it. Jeff, I wanted to ask you about insurance. So let's say you want to get let's say somebody does a smash and grab or something in your store. Are there any steps that you can take to make sure that you're going to get a payment from the insurance company?
Well, in insurance in general, it's very, very important at the front end that when you are completing the application for coverage, that you are truthful, that you're comprehensive in your answers, that you over-disclose. That's critical because a lot of people have a natural sort of tendency. I'm only going to tell them what I think they need to know, or I'm only going to share this, but I'm going to omit that. The challenge with that is that the insurance application becomes part of a contract between you and the insurance company. And a good insurance consultant or broker will try to get everything on the record because you're building a case file so that when the claim comes, the insurance company cannot come back to you and say, well, I didn't know this, or you didn't tell us that, or if we had known this, it would have been different. So we instruct our clients to give us everything. We put it on the application, we document everything so that in 6, 18, 36 months down the road when something happens, we can pull out the policy with the application complete as part of the policy and say that we told you everything. Our client followed their SOPs, they did everything right, something still happened, therefore pay the claim. We did our part, now do yours, right? So that's the importance there is to over-disclose, be accurate, don't lie, please don't lie. Be accurate and tell us the truth so we can present you in the best light and then build that case file ahead of time of a claim.
And what's the most popular insurance product that you're working with right now?
Well, most, from regulatory perspective, most regulatory entities are requiring at least general liability, which is the bare minimum but not enough. You need, as a dispensary or as a cultivator, as a processor, manufacturing, you need product liability because you're either selling or making a product. If somebody gets sick, they can say, oh, well, I got sick because of your product, or it's because, again, like anything else, the entire supply chain from seed to sale is getting sued when something happens, right? So that's why who you work with is important too. You don't want any weak links in your supply chain. So that is something that is critical. One other thing I wanted to mention, as part of your insurance portfolio, let's not neglect employee benefits and the appropriate life and disability insurance for the partners, buy-sell agreements, all these things that you would see in any regular business, you need in the cannabis industry as well to make sure that when something happens, a partner's disabled, they pass away, et cetera, you're not trying to figure it out at that point and trying to deal through the emotions and all of that, and there is no plan, right? Do your homework up front to take the emotion out of that part of it in what is already a trying time.
I think you could be a good therapist too. You're really good at you're really good with people. Sandy, you're going to talk about structures, the best structures for your company?
Yes, I'll make it shorter this time. Okay, so a flow-through entity is, let's say, an LLC. Automatically, a single member will be a Schedule C on your return, what we call a disregarded entity. A multi-member LLC will be a partnership, and an S corporation. All three of those, what they have in common is that they flow through to your individual return. So who's responsible? You are. And what's included in that is something that I call phantom income, those deductions pursuant to 280E that is not really taxable income, but you're going to pay taxes on it. And as such, your taxes are higher. But the problem lies in the fact that because cannabis is federally illegal, you are precluded from discharging any of that tax liability in a federal bankruptcy case. And you would be liable for these taxes, if something happened, for at least 10 years, because the statute of limitations is 10 years from the date of assessment. In contrast, a C corporation, a regular C corporation, gets taxed at the entity level, so you are not personally liable. You're preserving your livelihood here. And retroactively, you can cite some reasonable cause criteria to change your LLC to a C Corp. And you're not changing your entity structure, you're just changing how you're going to file for federal and state tax purposes. And when they deschedule cannabis, then you might want to strategize differently and maybe elect S corporation status.
Okay, great. I just wanted Tom and Sandy, what are your thoughts being in the accounting business? The IRS on one hand is saying, "Oh, pot is federally illegal. We can't let you take any deductions," and on the other hand, they're still taking all your money. So, is anybody suing them, or I don't? It might not be.
The IRS is trafficking.
Yeah, the IRS is essentially trafficking.
They
right?
are trafficking. If you look at it, they are.
We have
profiting.
applause over here on that. Yeah.
Yeah, yeah.
Is anybody suing them, or how can you sue the IRS?
No,
you can't really sue the IRS.
I keep up on a lot of cannabis case law. I've never seen any such case.
Tom, you have any more thoughts on that?
Yeah, actually, the thought that I had on that really is as it relates to this ERTC, the idea that federally, if the government doesn't recognize businesses that are in the cannabis industry, then how are we able to get this tax credit through the IRS? So the question that really pertains to that is the idea of it being a payroll tax credit or an income tax credit. So in this case, and we've done lots of research in order to see what it is, this is one of the risks of the cannabis industry. Thankfully, there's no really clear answer. So when it comes to an actual fraud type situation where you know you're doing something wrong, this is not the case. But whether this is a payroll tax, which your business is filing a 941, you're able to take that, or whether this is an income tax where you're not able to claim the payroll expense, therefore how do you get a tax credit? The train of thought really with most in the industry is that, first of all, there's sites of the Department of Treasury calling this a payroll tax. That's one of the things that helps. Second thing is the way that it's filed is on the 941 form, and really getting into some nitty-gritty, silly tax stuff that you guys probably don't need to worry about. There's a refundable portion of this and a non-refundable portion of this. And really what that's saying is the non-refundable portion, the first part of what you actually get, if you had tax liability left over, covers your payroll taxes. So it's a payroll tax credit. It's covering the actual payroll taxes you paid. The refundable portion is the part that goes to you as a business owner because you actually exceeded the amount of those payroll taxes. So all that talk right there makes this fairly simple to see as a payroll tax credit, but at the same time, leave it to the IRS to make up silly decisions that, hey, no, this applies some other way. So the industry right now really does see this as a payroll tax and therefore eligible for the cannabis industry. But as a business owner, that's on you. That's for you to think about, take into consideration, and really figure out what you want to do. I have some clients that what they did is they filed for this and they stuck that money aside into a savings account and said, until that statute of limitations is over, where I know I can't be audited anymore and make that go back, I'm not going to touch that money. And I think that's a great idea, quite frankly, especially if you figure the risk is high. Put it aside. Just save it until you know that you're not going to have any other problems with it, because that's the best case scenario. In this case, let's say something happened down the road and you were having to pay it back. This isn't a fraud scenario. You're not doing something against the rules that isn't coming out. It would have to change some sort of clarification of the rules down the road. So just a suggestion there.
Sandy has a couple of books under her belt. Maybe you should write one too on the ERTC. We talked about this on the call, before this, is key ingredients in risk management. Start with an attorney and a CPA and a lawyer, and also layer on insurance coverage. Those are the basic ingredients that you need. And you may also need somebody to help you manage your cash. So that's another thing with the insurance and managing your cash and everything like that. Sure. So what are you guys looking at down the road? I mean, a year from, are there any kind of, and all these rules are evolving. The landscape is always changing. We've got safe banking in the Senate. I don't know if you want to talk about safe banking, but is there any kind of rule or regulation or changes that might be coming? We mentioned the states with the 280E. Tom, why don't we start with Tom and work our way across? What are we looking at?
I think I'll defer to Sandy, because when we were talking beforehand, she sure had a lot of good impact and advice here. So that's why I wanted her to always go first, because she's got a lot.
I pay him to say that. But anyhow, I think it's imminent that we will deschedule cannabis. And once it's descheduled, we don't want it on Schedule 1, nor do we want it on Schedule 2. And when it's descheduled, then we won't have 280E and so forth. But other things will come into fruition. First of all, we don't want a federal excise tax that will be more punitive than 280E, especially, I guess, more applicable for growers or processors. We don't want such federal or, control over it that the costs are so high, the compliance cost is so high that it puts out businesses like yours, and that it ends up in Big Pharma and Pepsi Cola and Target and all those things. So I think we have to be mindful that before it's legislated, to lobby it in such a way that it will be equitable and beneficial for you.
Okay. Jeff.
Well, one of the things I think that is I wouldn't call it imminent, but one of the things that we in our industry, in the insurance industry, are really pushing for. We talk about insurance, we talk about employee benefits, right? We talk about health insurance and prescription, vision, dental, all those things. One of the things that my partner, Nichelle, who has joined us today, so we appreciate her being able to make it today. One of the things that we are pushing for with our advocacy hat with respect to minorities for medical marijuana and the Coalition of Medical Marijuana in New Jersey is pushing for medical cannabis to be a covered employee benefit, right? And have to be actually part of any other medicine that you would get from your benefit plan.
Right, you can't get reimbursement right now for your medical cannabis, right?
Because the federal cloud, that's an issue. But one of the things that at the state level we're pushing for, other states as well, is there are active bills on the floor of the legislature in New Jersey, is to provide a way for those scripts to be covered. That will be a game changer in a huge way. If we can do that, to have medicinal cannabis be available, like a script for metformin or any other drug would be, right? Any other medicine would be. So that's a work in progress. I believe that is one of the most significant things that's coming as it pertains to insurance, as it pertains to businesses, is the ability to have that be a covered benefit.
Is the insurance industry pushing back against that, so they don't want to have to pay, or are they?
No, not really. I mean, it's the excuse always is when Washington figures it out, then we'll get involved. So that's kind of their catch-all answer. But what I would say is that I believe a lot of these things are inevitable. The descheduling, et cetera, all that will come once Washington finally decides it's important enough and the right people are involved. We know how that works. Then it will happen, right? So and we're getting there. It's a work in progress, but we owe it to all those who come before, all those who suffered under the war on drugs as it pertains to cannabis, the families that were destroyed, lives that were taken, livelihoods that were interrupted. We have a responsibility as policymakers to make sure, and those in the industry, to make sure that we make these folks whole and their families whole, and that's the reason why this industry is so important.
So compliance really is it's really a people business, and so is accounting, because you have to, you have all the rules. It's black and white stuff, but in the end, it's really what relationship you have with your client. So give us some good stories, some success stories out there where your products or your or the industry really has provided some support.
Yeah, I'm glad you asked that, because I've spent so much time here probably scaring everybody away from ERTC that we don't realize it is a benefit. It's a huge benefit. And I think one of my favorite stories, so we're based out of Washington State. I was working with someone that was only a couple hours away, so it was kind of fun to know their geographic location and what they did. This was a small business owner, had about 10 employees, and she told me the story about COVID and how thankfully they survived through COVID, even though it completely ruined their business. And by doing so, the only reason they survived is because they had this savings account. They were just getting ready to open up a second location with this $150,000 sitting in savings. And we go through it, we qualify her for the periods that she has, we come up with all the numbers that we do, and we find out that in the end, she's getting back $147,000. It made up everything that impacted her from COVID. And if she didn't have this, she wouldn't have been able to go and do what she was doing before. So again, it's the idea that these businesses that did okay, figured out how to get through COVID, those businesses, even though they figured out how to survive, still are eligible to be able to take advantage of something like this. And I love the fact that, because I'm a people person, if this didn't have such a benefit to small business owners, I personally wouldn't be as attracted to this as I am. I hear stories every day, and I encourage my employees to, when they're working with these small business owners, if they have these stories of these lives that have been changed, share them. So as a company, we make it a point to share those internally, and that was my one from a while ago.
But it does seem like a really good benefit. What are the basic things that an owner has to know if they can pursue this? Basically.
Yeah, actually, we get asked that a lot. So you had to have employees during COVID, so 2020, 2021. It is okay if you did better through that period. So if your sales went up, a lot of business owners say, hey, my sales went up, I don't qualify. That is not true. There are other ways to qualify, typically by government mandates. It has to be a required government mandate, cannot be something that's a suggestion. Has to apply to both your jurisdiction, so where you geographically are located, and it has to apply to your industry. So those are the steps that somebody's working with you or making sure to go through that you qualify for there. And then there's a slew of other rules that apply to this. As I said, the PPP deductions, the related employees, things like that, that are always the steps that's why this is complicated. Nobody can tell you right off the bat what you're going to get. You need to go through each of those steps and work with a provider that can tell you what all those look like.
Okay, Sandy, give us some good stories.
Okay. Well, I can cite, there's not many successful, quite frankly, court cases in terms of, case law. A lot of the case law seems to always be in California. Gosh, I have a lot more bad cases. The only one real victorious case was the Champs case. And that's where there was a cannabis dispensary that also, they sold cannabis, but they also had a business, like a caretaking business, where they had luncheons and did yoga and different things like that. And in that particular case, the IRS allowed a lot of deductions that would otherwise not be allowed, because they held that that caretaking part of their business was able to stand on its own 2 feet in terms of revenue and expenses and be profitable. Unfortunately, subsequent to that, there were many cases that did not fare as well. Cases that kind of gave things away for free and say, but we do offer yoga, or we do offer caretaking, etc. Management companies that will never fare well as well. So that, unfortunately, in the cannabis industry, again, there's not many case law that is positive.
What's a bad one then? Give us a bad one.
Bad one? Oh gosh, we have a bunch. Aldermans. Let's see. Well, I'll go with the Alternative Healthcare Advocates versus Commissioner, December 20th, 2018.
Where was that?
That was California dispensary, of course. And they had a management company, U.S. Wellness Management, I think was the name of it. And they took care of things like HR and advertising, marketing, and operational. And the cannabis dispensary would pay the management company and deduct its expenses and so forth. Well, the IRS came in and held that they were using the same pool of funds. And consequently, the management company was subject to 280E. So management companies almost never work. It doesn't change the nature of your expense. If advertising is not an allowable expense, it doesn't matter that you're paying a management company to facilitate that. It's not going to hold weight. And when we've had clients, what we did is we tried to rebook everything as loans to clear it up, because let's face it, often it's hard to get banking, and people out of desperation do a lot of things. They use their personal banks, their personal funds, other businesses. We get it, but it should be recorded properly. But management companies will potentially adversely affect your livelihood.
Okay, I'm going to stop you there. We're almost out of time. Jeff, any good stories or bad stories you wanted to share real quick, and then we'll wrap up.
One story that comes to mind is one of our earlier clients as we started working with the cannabis businesses. Again, for HIPAA reasons, I won't give the name, but really the founder of the company and the face of the company really helped drive them. He got sick, unfortunately, and passed away. And he really was the face and really driving business development, et cetera. Fortunately, we had a key man life insurance policy on him, and we were able to help them through that process where they were already grieving the loss of their leader, but now financially they were going to be okay. So again, it wasn't something that was super sexy to talk about or all that interesting, et cetera, but insurance is designed to make you whole and to provide a filling of a gap when the bad things happen, and they do.
Okay, well, we're pretty much out of time. Thank you very much for joining us. Thanks to our panel. We've got Sandy Suchoff, Jeff Booker, and Tom Saugaveau. Thank you.